Hey, welcome. You know that feeling when you're on vacation, you pull out your wallet and you just kind of stare at the local currency and you think, wait, why is my money worth so much more here? Or, sometimes so much less than back home? Well, today we're going to dive right into that puzzle. We're talking about the wild, fascinating world of exchange rates.
Okay, so let's make this super concrete. Picture this. You're in New York City, and your $1, well, that might get you a cup of coffee if you're lucky. But then you hop on a plane and land in Hanoi, Vietnam. And that exact same dollar can now buy you a whole delicious meal. How does that even work? I mean, shouldn't a dollar just be a dollar no matter where you are in the world?
All right, let's look at some actual numbers. Let's say you take that dollar to, I don't know, Germany. It'll trade for about 90 euro cents. Okay, so it's a little less valuable, but it's, in the same ballpark. Makes sense, right? But then you take that same dollar to Vietnam, and suddenly, poof, it explodes into 25,000 Vietnamese dong. 25,000. You feel like a millionaire, right? And that massive difference, well, that's the mystery we're here to solve today.
So how do we start to piece together this giant global money puzzle? Why are all these numbers so different, and why are they constantly changing, like every single second? Well, it turns out there's a really fundamental economic force pulling all the strings.
And here it is. The answer is actually pretty simple, but it's also incredibly powerful. It all comes down to supply and demand. Yep, that's it. Think about it. Just like the price of coffee, or gasoline, or even avocados, the value of a country's money is all about how many people want to buy it versus how many people are trying to sell it.
So, an exchange rate? It's really just the price of one currency, say the dollar, quoted in another currency, like the euro. And this price isn't decided by some secret group in a boardroom somewhere. Nope. It's set in these enormous, worldwide, totally decentralized markets called the foreign exchange, or FX markets. And get this, trillions of dollars change hands on these markets every single day. It's a massive, global auction happening 24/7.
Okay, but to really get what drives supply and demand for something as abstract as a dollar bill, we've got to peel back another layer. We need to take a quick trip back in time to understand where money even gets its value from in the first place.
So for a long, long time, most of the world was on what's called the gold standard. It was simple. A country's money was directly linked to gold. You wanted to print more dollars? You needed more gold sitting in a vault somewhere. Simple as that. But then, around the 1970s, things changed. Big time. Most countries switched over to a totally different system. Fiat money.
And this is a really key idea for how our economy works today. Fiat money, which is what the US dollar is, has value simply because the government says it does, and more importantly, because we all believe it does. It's not backed by a pile of gold anymore, it's backed purely by our collective faith and trust in the strength of the economy that issued it. Kind of wild when you think about it, right? It's money backed by trust.
All right, so if a currency's value is all about trust, what builds or breaks that trust? Well, it turns out there are two big levers that governments and their central banks can pull, and these levers have a huge impact on the supply and demand for their money.
Lever number one is something we've all been hearing about a lot lately: inflation. Put simply, inflation just means your money is losing its punch. You know that $10 bill in your pocket? It just doesn't buy as much as it did last year. The prices of things are going up.
So how does that connect to exchange rates? Well, it's all about something called purchasing power parity. Let's imagine for a second that everything in the US suddenly becomes, say, 20% cheaper than the exact same stuff in Europe. What do you think would happen? Well, smart traders would see a huge opportunity. They'd start buying up all those cheap American goods. But to do that, they first have to sell their euros and buy a bunch of US dollars. All that buying pressure drives up the demand for the dollar, making it more expensive. And all that selling of the euro makes it cheaper. This happens until that price advantage disappears. It's a self-correcting system. And this is exactly why your dollar can buy a whole meal in Hanoi. The exchange rate has already factored in that things are just generally cheaper there.
But hold on, we don't just use money to buy things, right? We also use it to save and invest. It's a way to store value. And that brings us to the second huge lever, interest rates.
Here's how this works. Imagine a country's central bank decides to raise its interest rates. This is like them putting a giant flashing sign on their financial assets, like government bonds, that says, "Get a better return here." Investors all around the world see that sign. They want that higher return, right? So what do?
They sell their own currency and buy the currency of the country with the high interest rates. And what happens when everyone wants to buy something? The price goes up. The currency gets stronger.
Okay, so we've got inflation and we've got interest rates. But really, those are just two grades on a much bigger report card. Because at the end of the day, a currency's value is basically a daily public report card on the entire nation's economic health and stability.
Think about it. When big investors are deciding where to park their billions of dollars, what are they looking for? They're looking for signs of a healthy, stable, well-run country. They want to see a government that's not going to fall apart, a strong economy, a country that sells a lot of stuff to the rest of the world. They want low debt and, yep, low inflation. A country that can tick all those boxes, that's an attractive place to invest. And that demand for their currency makes it stronger.
And this quote really just nails it. A stable government means predictable rules. I mean, if you're a business, you don't want to invest somewhere if the laws might completely change tomorrow. It's just too risky. Money absolutely hates uncertainty. That predictability, it's incredibly valuable.
Now you might be thinking, okay, I get it. Just look at the country's economic report card and you'll know where the currency is going. And if only it were that simple. But there's one more massive layer of complexity here. And it turns this whole thing into a giant global guessing game.
So you've basically got two kinds of players in this game. First, they're the arbitrageurs. These guys are looking at the prices right now and trying to profit from tiny differences. They're reacting to what's happening today. But then you have the speculators. Their job is totally different. They're trying to predict the future. They're placing bets on what they think inflation and interest rates will do months or even years from now.
And here's the kicker, the thing that makes this so tricky. Because you have all these incredibly smart people, speculators with supercomputers, all trying to outguess each other, all of their predictions about the future, they get baked into the price today. It's already priced in, and that is why predicting where a currency is going to go tomorrow is just so incredibly hard.
So let's just end on this one big idea. If a currency really is like a stock price for an entire country, if it reflects everything from its economic health to its political stability to the world's collective bet on its future, then what are the day-to-day wobbles of the dollar, the euro, the yuan? What are they really telling us about what the global market thinks of the world right now today?